Hello and welcome to the Charter Hall Direct Insight series. I'm Stephen Bennett and I'm the CEO of the Direct business here at Charter Hall. I'd first like to begin today by acknowledging the traditional custodians of the land on which we each gather today and pay my respects to the elders past, present and emerging. And thank you all for joining me for this update on Charter Hall and our suite of funds for the December 2022 quarter. During this quarter, all our properties across the Direct suite of funds were independently valued. As highlighted in the quarterly report, which each of you should have received, some of our property portfolios saw a slight decrease in value, and this was driven by a softening in economic conditions, primarily as a result of the fastest increases in inflation and interest rates we've seen in the last 20 years. I'll be providing you with more insights into the valuations later on in today's presentation, as well as the key thematics of the various sectors. All of our Direct unlisted funds have continued to produce above benchmark returns since they were first launched, despite some of this short-term underperformance for a couple of the funds. It should also be noted that unlisted Direct property funds have generated a positive 12-month return, with the only exception being the Maxim Fund, which invests into listed property securities and has been impacted by the negative gyrations on equity capital markets throughout the world. But before I get into today's presentation, I should also highlight there'll be a Q&A at the end where I'll be answering a number of pre-submitted questions from our investors and advisors. And if you've joined us before, you'll know that there is no live Q&A. However, if there's anything which we don't cover today, please do reach out to the team by phone or email and we'll endeavour to respond to your query as quick as possible. And as I always do at these presentations, I do need to remind you that we are not able to provide financial advice. So as you can see on the disclaimer up on the screen, it is important that you consult your financial advisor, read the information and PDS offer documents, as well as consult the risk sections. And today we have a special guest speaker. We have David Harrison, who's the Managing Director and Group CEO here at Charter Hall. And David will be providing his views on how he sees the current economic conditions and what impact have they had on the Australian commercial property market. So stay tuned, we'll have David up very soon. And as is always the case with the Insight series, we'll provide an update on the fund performance. In this case, we'll also touch in detail on the valuation process which was undertaken, as well as take a little bit more of a deep dive into the funds and what their key attributes and drivers were. So now I'd like to introduce David Harrison. And as I just mentioned previously, David is Charter Hall's Managing Director and Group CEO with over 36 years global property market experience. David has transformed Charter Hall from $500 million of assets to $86 billion of assets under management in the last 16 years. Thank you very much for joining us, David.
Pleasure.
So the first question, at the macro level, in the last 12 months we've seen a lot of disruption. We've had interest rates and inflation shoot up. We've had a war in Europe, which continues to this day, unfortunately. What do you think the implications are for the Australian commercial property market?
Well, I think you've got to look at all of those external factors, and the highest impact factor is obviously rising interest rates, where central banks have been moving interest rates up in response to, higher levels of inflation. I think the war in Europe has less of a direct impact on Australia, notwithstanding the fact that it creates, global unrest and uncertainty. But I think overall we're seeing signs globally that the interest rate cycle will soon peak. Certainly the bond yields, 3, 5, 10-year bond yields are suggesting the market feels that we're approaching that sort of peak cash rate. Don't think we're quite there in Australia, but there's no doubt that the rate of increase is going to slow down. So I think that will, during the course of this calendar year, create some more stability, less concern around how long interest rates are going to be rising. And then I think there's also an expectation that there'll be a slowdown in the economy. Unemployment may not stay at sort of record lows of 3.5%, and we're probably going to see, as the lucky country, continued demand for our commodities. So I think Australia, from an economic point of view, has probably got less chance of avoiding a technical recession or even a hard recession than other countries in the world. So I think we'll move through this year. It'll be less volatile than perhaps the listed market has suggested. And as I said, I think Australia will get through relatively unscathed, notwithstanding the macro outlook.
So less volatility of what we've seen in 2022, which was a pretty volatile market.
It was, but as we've seen from the performance of our property portfolios, the great thing about commercial property with good leases and built-in rental growth, you can absorb some movements in cap rates with income growth, and the asset values are fairly resilient. So I think that will continue for the really good quality assets, office, industrial, and retail. And I think we're no doubt we're going to see a bifurcation of the better quality assets and the more modern assets performing better than older stock.
That's good, and I'm actually going to touch on that a little bit later in today's webinar, where I'll run through the trends which we observed through the December independent valuation process. So David, I guess you can look forward. It sounds like it's going to be less volatile. So do you think there's going to be some opportunities, particularly to maybe pick up some assets with less competition at maybe better pricing than what we could have in the last 12 months?
Oh, look, I think when I look through 3.5 decades in this industry, there's always opportunities. There's always a lot of talk about, will there be distressed selling? And, through the early 90s recession and post-GFC, you don't actually see that much in the way of distressed opportunities. So we've got our eye out for things. You're right, there's less competition. A lot of the syndicators and privates that would have traditionally used a lot more gearing than Charter Hall would are going to struggle to make those things work, because cost of debt's obviously higher, and the availability of debt at higher gearing levels for those sort of borrowers just isn't still there. So I think there'll be less competition. People who, like us, have been quite selective and focused on good quality tenants and good quality assets will perhaps be able to buy a bit better. Yep. But remember, we also have a $16 billion development book. So at Charter Hall, we have the ability to produce our own institutional grade assets and not just have to buy them off other people. So that's one of the benefits of being $80 billion and having a $16-17 billion development book. You can create your own good quality institutional real estate.
And that's a good lead into my next question, actually. When I started at Charter Hall 13 years ago, we were much smaller, and in the introduction, I talked about how since your time it's grown from 500 million to over 80 billion. In fact, we're now the largest owner and manager of commercial real estate in the country. What do you think have been the key drivers for that? Because it's not easy. You've got to build the assets or acquire them. What do you think has been the success here and why we've grown so strongly?
Well, I think it's pretty simple. You have to be customer centric. We've got two types of customers. We've got our investors that give us capital and entrust us to deliver returns for them, and then we've got our tenant customers, where we are the largest owner of real estate, and we've got to that position by having a lot of repeat business tenant customers, whether it's 32% of our $30 billion office portfolios are leased to government. We've got all the great brand names that all of our investors would know well, from the Woolies to the Coles to the Audis to the Telstras. We're
across sectors too.
Across all of our sectors, and we're generally the largest landlord to all of those high quality tenant customers. So I think that's been our focus. I think the other reason why we've been able to grow, we have provided our investors, from sort of mum and dads through to high net worths, and obviously a lot of our advisors and their clients have had access to the same high quality product that our big super funds or pension funds have, and so we run a large unlisted business, and we also manage 3 listed REITs. So I think the reason we've grown and been successful is A, we've been able to be customer centric, B, we've performed for our investors, and C, we've been able to offer product, whether it's an industrial fund or an office fund or a diversified fund with, high focus on consumer staples and CPI-linked rent reviews to a whole variety of, different investors. And I think that's really been why we've been able to grow. Just like I said, repeat business customers on the tenant side, a lot of our large investors are invested with us across multiple strategies and multiple funds.
Absolutely, and the develop to core or develop to own pipeline is a big advantage. But where we're acquiring assets, how does Charter Hall do it? And I often get asked, do we have the same strategy as other property managers in this space, or what sets Charter Hall's ability apart in accessing some of the highest quality real estate?
Oh, look, I think it's well documented over the history of Charter Hall. The majority of the assets we do acquire, we acquire off market, not in competition with people in auctions and tenders. Quite often it's sale and leaseback with big tenant customers, whether it's a Woolworths or a Telstra or an Aldi or a Coles. So it allows us to secure assets efficiently. We've also got the largest transaction team across multiple sectors in the country, from office to industrial to social infrastructure to retail. And I think that just gives us a visibility into great assets. We've also been able to offer many of our customers access to great portfolios, whether it's the Telstra Exchange portfolio, whether it's the BP or Ampol portfolios. We're a huge proponent of sale and leaseback. So we talk to our corporate customers, and we continue to do a lot of off-market sale and leaseback transactions with some of the great global brands that our investors would associate with. So I think they're part of why we've been successful in sourcing good quality assets and quite often avoiding the competition of auctions or tenders.
Okay, and that is important, that off-market process. And as I've said to this audience many times before, it's not just acquiring the best real estate. We do have people located on the ground where we own the assets. So that local presence, as you said, David, the tenant customers, we understand what they want, and that allows us to do better leasing deals than many of our peers.
And that is important. We're one of the few, if not the only, national businesses that have full service offices in every capital city of Australia, from property management, leasing, development, asset management, funds management. A lot of people do a centralised approach. We've been great believer in having great local talent in interstate offices, whether it's Melbourne or Brisbane or Adelaide or Perth, and I think those are really important elements. And also having shopping centres dispersed right throughout the country gives you a lens into many different markets. So I think they are important ingredients.
Okay, and look, changing tack lightly, I'll give you two questions. You can answer one or both depending on how you feel. What's the most common question you get from the many wholesale and largest investors in the world? And are there any final thoughts that you want to leave our audience with today?
Oh, look, the most common question I get is, how are you going to deliver better performance than your competition? So, if you're a large pension fund, super fund, they're under pressure to perform for their members, just like we are as a manager. So that's the most common question, and fortunately, it's an easy one for us to be able to answer with the historical performance tables we've got. And I guess the other, sort of common question I often get is, what's the next big thing? What's everyone else not doing that we should think about that might sort of give us a competitive edge, or give us a higher performance, or give us a first mover advantage in various things. And we've obviously been able to do that in social infrastructure. We've really been the front runners of the triple net sector and the long WALE strategy, and particularly the long WALE strategy linked to uncapped CPI increases, where, as we've been benefiting for 7 or 8% rental increases. But But I think, quite often it doesn't matter whether I'm, talking to one of my friends who invests with us, or an advisor, or a large super fund, or a global pension fund. They're quite often the same, typical questions people want answered. And obviously, I think one of the other most common question is, do you have the management team with the expertise? And clearly, with nearly 700 people and sector-specific specialists across all of the sectors, we have got a very capable and experienced team that can, deliver results for our investors.
Fantastic, and thanks, David. Really great to have you here today. And
No problem.
I'll just reiterate what David mentioned then, the level of experience and expertise across the Charter Hall team, starting right at the top here from David, is how we can access those great assets, and the executive team, as well as all the teams throughout the sectors, is fantastic and very, very focused on the investor outcomes of our fund. So thanks again, David. Appreciate your time.
No problem. Thanks, Steve.
I'm now going to take this opportunity to run through some of the key statistics on the direct business. So we manage $11 billion of funds under management across both the closed and open suite of funds. The reason why I'm raising that is because it brings scale benefits. We can negotiate hard and get great interest rates with all the key banks and financiers. It means we've got deep relationships with our tenant and agent customers, and it means that we have access to over 600 property experts throughout the Charter Hall Group who are located on the ground where we own these assets. And if you are an investor with us, rest assured, whether you've got $10,000 or $2 million in the funds, we're very conscious that we're the custodians of other people's capital, and it's a responsibility that we take extremely seriously. And on the right-hand side, you can see a number of awards which we've recently won, and I'm not saying that to brag, but I do think it's a reflection on the quality and the returns we've been able to generate for our investors over a long period of time. So as is tradition, the first thing I talk about is the 12-month returns on the open funds. And as you can see, DIF 4, the Industrial Fund number 4, and LWF, the Long WALE Fund, significantly outperformed the benchmark. And we use the MSCI Wholesale Fund benchmark here at Charter Hall, and that's because it compares us against other high-quality institutional-grade property. Unfortunately, the two office funds, DOF and PFA, did underperform, and there is a question from an investor which I'll explain in more detail on why that was the case for some funds and not the others. And as I've always said, if you're invested into property, you shouldn't invest for a short period of time. So what I'll explain now is how the funds have performed since inception. And inception just means when the funds were originally launched. The grey bars in the chart up there on the screen represent the benchmark, and the blue bars the respective fund performance. And I should also highlight that these are the returns per annum. So as you can see, all the funds have outperformed the benchmark since the time they were launched, and these return numbers are a composition of both distributions as well as movements in the fund's unit prices. So those since inception returns are for the open suite of funds. They are funds that are currently open for investment. But I do know a number of you are invested into our fixed life funds. But it is a very similar story. The blue bars show the fund performance, and each of these fixed life syndicates has significantly and materially outperformed the MSCI benchmark, highlighted in grey. At Charter Hall, we believe it's very important to get frequent independent valuations. It enhances transparency for investors in the funds. And to do that, we get everything valued typically at 30 June and 31 December. And I can tell you every asset in the portfolio was independently valued during the December quarter. Up there on the screen, you can see the outworkings of these valuations. You had some small decreases across many of the funds. This was driven by an increase in capitalisation rates following the fast and rapid increases in interest rates. For industrial, it was largely offset by growth in market rents, but for the office sector, particularly the lower quality assets or assets that had upcoming vacancy, they were most affected. So whilst a negative return is not a great result and not something we hope to achieve, I do encourage you to keep it in perspective with the volatile year that 2022 was. We saw very rapid increases in inflation. We saw volatile and negative returns on the equity capital markets. So this actually shows the benefit and stability that unlisted property can provide. And as you can see, the 12-month returns were positive for all funds except the Maxim Property Securities Fund, which is liquid and invests into the stock market traded property stocks. So what were some of the valuation insights which we gained from having 1,700 assets across the whole Charter Hall Group independently valued during the December quarter? Well, what I'll do is I'll take you through the core sectors and give you the ups and the downs and what we see will be the likely trends going forward. Starting at the office sector, you continue to see a flight to quality. There wasn't as much transactional evidence, so less sales and less purchases, and that actually applied to most of the property classes during the second half of last year. Investment sentiment has remained the strongest for the prime, i.e. highest quality institutional grade assets, and the assets that have long-term leases to very strong tenants. And when we're talking to key tenants, so CEOs, heads of property, one of the reasons they want quality office space that has great amenity, close to public transport, great meeting rooms, natural light, is because they want to attract and retain key talent. It's also assisting them with getting their staff back into the office. In the industrial and logistics sector, transaction volumes also slowed off a very robust first half. It definitely came off during the second half. But we did continue to see strength in the e-commerce and tenant demand remained very strong, which ultimately drove around 22% rental growth across the Australian industrial market. In fact, strong market rental growth and access to many leases that had CPI-linked rent reviews mitigated much of the softening in property yields across the industrial and logistics sector. In the diversified and long WALE sectors, investor demand, particularly from private capital who are seeking prime assets supported by high land values in metropolitan locations and top tier or tier 1 tenant covenants, remained strong. And social infrastructure. These assets remain buoyant due to the essential nature of the asset classes. So to summarise the trends which we saw from the valuation process, for office assets, only stick to the highest quality property. It's what investors and tenants want. In industrial and logistics, rental growth is still likely to continue, but unlikely to be as strong as what we observed in 2022. In social infrastructure and long WALE assets, we believe there'll be opportunities to pick attractive assets up with less competition and at better price points. So I've just talked about the independent valuations and the trends which we saw in the respective property sectors. But something else that's very important in driving stronger valuations over the long term is what's the manager's ability to lease up the properties and keep high occupancy rates and achieve strong market rents. Well, as you can see up on the screen, I've provided a selection, and this is a small selection of some of the leasing deals which we've done recently. You can see it spans the office funds as well as the industrial fund, and they range from long-term deals, 10 years, to shorter-term deals for a sitting tenant where we've been able to extend the lease term. It's important as a manager that you stay close to your tenant customers, understand what they want, and that way you can create win-win scenarios for both your tenant customer and lock in secure cash flows for the benefit of investors in the funds. At Charter Hall, we're very active. We don't wait for a leasing expiry to come up. We're looking 5, 6, even 7 years and longer out and making sure that we can lock in secure cash flows regardless of the property sector which we're invested into. I'd now like to show you one of DIF4's high-quality assets located in one of Western Sydney's premier industrial precincts, Eastern Creek. The asset completed construction during 2022 and comprises 4 modern industrial facilities, which provides for premium industrial accommodation across 3 tenants. The property is 100% occupied and has a weighted average lease expiry of 8.8 years. I hope you enjoy this short video. This now brings me to the part of today's presentation where I'll provide an update on both the open for investment funds as well as the fixed life funds. The first fund is DIF4. This is the fund that had that Eastern Creek asset in, which you just saw the video on. It's a large fund at $3.14 billion, and it actually acquired the DIF2 portfolio of assets during January, taking its funds under management to $3.5 billion. It has some fantastic tenants in the portfolio, and as you can see, there isn't any material exposure to these tenants, with the largest tenant outside of the government being only around 7%. It benefits from 100% occupancy, long weighted average lease term of 10.6 years, and has achieved an 11.7% annual return since it was first launched. And remember, these annual returns are a composition of both the distributions for DIF4, which are paid quarterly, as well as movements in the underlying fund's unit price. So we often talk about the assets that the funds acquired, but it's also important to look at the assets which we've sold. And we will sell an asset at Charter Hall where we believe the risk-adjusted value has been maximised. DIF4 sold an asset down in Dandenong South, and we achieved a sale price 20% above book value. And this asset, since the time we acquired it, generated an 18% internal rate of return. This is what you'll see us continue to do at Charter Hall. We'll recycle out of smaller, non-core assets and continue to focus on portfolio curation, which simply means we're going to lift up the quality of the portfolio as we do with all our funds over time. But that asset wasn't the only one DIF4 sold during the quarter. It also sold a smaller asset down in Morningside. We achieved a strong internal rate of return of around 9.5%, and again, we sold it above the book value that we're holding it at. So whilst these assets are small in comparison to the overall size of the fund, with over 50 assets in DIF4, you will see, as I just mentioned, some portfolio curation come through, particularly over the next 12 to 18 months. The next fund I'll talk about is the PFA fund. It's a $2.5 billion office fund which is geographically diverse and focuses on properties that are leased to the state and federal governments. These properties and these government rental streams are the majority of the net income of the fund. PFA's generated a 10.1% return since inception, benefits from strong environmental credentials, which is important if you want to attract those government tenants, and has a 99% occupancy rate. PFA also recently closed its 5-year liquidity window, and as per communication to those investors, management are implementing a strategy to deliver that liquidity during 2023. Moving now to DOF, the Direct Office Fund, which is a $3.22 billion fund. It's continued to perform very strongly over a long period of time. I've put up there on the slide showing where the assets are located. And as you can see, 94% of the portfolio is weighted to the eastern seaboard. That isn't an accident, but we've purposely weighted it there because these are the deepest and most liquid markets. The fund has generated a 14% total return since inception and also benefits from strong environmental ratings. The largest tenant is the Australian government, but it is not as high as compared to PFA. But the fund does benefit from other strong tenants such as the Western Sydney University, Coles, Suncorp and Westpac, who round out the top 5 tenants in the portfolio. The weighted average lease expiry for DOF also is 6.7 years, which is quite long for an office fund diversified across a number of assets and throughout the country. The next fund I'll talk about is LWF, the Long WALE Fund. It's the first diversified property sector fund I've talked about, whereas DOF, PFA and DIF4 are all sector specific. It's for those investors who want to rely on the expertise of Charter Hall to weight it across different sectors and who don't have a strong view on which sector will outperform. It's over a $600 million fund, has a 99% occupancy rate and has delivered a 10.6% return since it was first launched. It has a long weighted average lease expiry of 8.7 years, particularly when you look at how many assets it's invested into and across the different sectors. For those investors or advisors who have exposure to LWF, it has its 5-year liquidity event coming up in Q2 2023, and do keep an eye out for the communications as we get closer to that event. The next diversified fund is the Wholesale Property Series number 2. This fund is open for a limited period of time and then it closes. It's the second in the series And again, it is diversified. I do want to stress though that it's only available to wholesale investors, and it does have a high minimum investment amount of $250,000. You can see the asset sector exposure up there on the screen. It has a long weighted average lease expiry of 11.5 years. It invests into a number of wholesale funds and partnerships, and when you look through the portfolios, has exposure to over 220 assets. So for those investors who like getting exposure to institutional property that's usually outside the reach of high net wealth investors, this could be something that is of interest to you. The next fund is the Maxim Property Securities Fund. And as I mentioned at the start of today's presentation, it invests into listed stocks that are traded on the Australian stock market. For this reason, it is more volatile than the unlisted direct property funds. Unfortunately, like a lot of the equities markets, it did achieve a negative return in calendar year 2022. Importantly, across both the 3 and 10-year period, the fund has outperformed the benchmark, which is highlighted in grey. I've also put up here a short case study on one of the stocks that the fund invests into, Aspen. It's a non-index stock that provides affordable accommodation. They target Australian households that can't afford more than $400 weekly rent or $400,000 to purchase a property. In this category, it's estimated that demand is more than 4 times supply that's available, and it has a highly experienced management team that have delivered outsized returns. Rounding out today's fund update, I'll now talk about the fixed life funds. These are funds that many of you are invested into, but which are closed for new investment. The first fund, the BW Trust, has done exceptionally well over the long term, despite it having a lower return of 4.4% for 12 months. DIF2, which isn't on the screen, we gave investors an election to either redeem in full, taking cash, or to roll their securities in a tax-efficient way into DIF4. It's important at Charter Hall that we gave investors that choice, and it was completely up to them. DIF3 has performed extremely strongly, and it has its liquidity event in Q3 2024. It still benefits from 100% occupancy and has a long average lease term of 11.1 years. And the Wholesale Property Series number 1 has generated a 15.4% per annum return since it was first launched and did a 9.1% return over 12 months. It also benefits from a 98% occupancy and exposure to a large underlying property portfolio of over 200 assets. That now brings me to the part of today's webinar where I'll answer a number of the questions that have been submitted during the quarter. The first question is around the fund performance. Why did some of the funds beat the benchmark, whereas some didn't? Well, the first thing I'd highlight is the fund benchmark is the MSCI Wholesale Fund Index. The 2 funds that beat the index, DIF4 and Long WALE Fund, and the 2 funds which underperformed the benchmark in the last 12 months were DOF and PFA. The benchmark index did well this quarter, particularly as it has a higher weighting to discretionary malls, so think big shopping centres, which we don't have exposure to. So that's largely the reason why the benchmark did well. And as I mentioned earlier, we should always consider property to be a medium to long-term investment. And even those 2 funds which underperformed in the last 12 months have outperformed on a 3 and 5 year metric. So the second question relates to, I believe, the volatility that's happened and perhaps some concerns people have. So the question reads, if the economy slows down, do we have concerns around the tenant quality in the portfolio? So look, it doesn't say which fund, but I address it from all of them. What I would say is we're absolutely focused on the tenant quality. It's not an accident that the largest tenant in a number of the funds, in fact, DOF, PFA, LWF and DIF4 is the government. But whether it's the government or not, we do a lot of due diligence. When we're looking at corporates, we want tenants that have strong balance sheets, good cash flows. And I get a lot of comfort that we just came through arguably the biggest disruption to the economy we've seen in the last 50 years being the global pandemic, and our tenant quality stood up very strongly. So I can tell you that the tenant quality or tenant defaults isn't something that gives me any concerns. It's a good question, and I do always encourage people, if they are looking at property investments, dig into who are the tenants, who's paying the rent, and are they strong, and are they likely to go through different economic and market cycles. The third and final question we have for today says, LWF opens its liquidity event in Q2 2023. Can you explain how the fund meets its liquidity requests? Well, LWF is the same as our other open funds in that it has 5 yearly liquidity events where we write to investors and the investor makes an election to stay invested, to redeem partially or redeem in full. So the 3 ways which we meet liquidity, and it's often a combination of these, we will sell non-core assets or assets that we believe have maximised the value. For funds that have quite low gearing, we'll draw down some of this gearing and get back to within the target gearing levels which we want to be. And these funds are always attracting new investors who want exposure to institutional grade property. So we do continually get the equity recycled. And through these 3 mechanisms, this is how the funds typically meet their liquidity events. That concludes our update for the December 2022 quarter. Thank you for joining me today, and I hope you've gained some insights into our funds and our views on the current economic conditions. If you have any questions on something you've heard today or anything else, please do get in contact with our team. We'll be more than happy to assist. Thank you.